Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day. Today is February 27th, 2026, and I'm thrilled to welcome Edward Dowd to the program. A former portfolio manager at BlackRock, where he managed a $144 billion growth equity portfolio for a decade. He is also an author and a founding partner of Finance Technologies. A storm is coming. These are Ed's words regarding the cracks he's seeing in the broad market that he thinks will lead to a 40 to 50% drawdown as the AI story collapses, the real estate market plunges, and a demographic crisis in China sends shockwaves through the global economy. Edward also reveals how long he thinks this upcoming bear market could last. Are we in for a Japan-style lost decade, or will stocks rise quickly from the ashes? We also dive into the Epstein Files, whether the aliens really are coming, and so much more, so strap yourselves in for my conversation with Edward Dowd. Edward Dowd, great to have you back on Commodity Culture. You released your U.S. economy outlook for 2026 at the end of last month, where you outlined three major risks: a white swan housing crisis, the stock market AI bubble beginning to crack, and China's real estate and demographic crisis having contagion effects. Let's start with the housing crisis. What do you mean by white swan crisis, and what are the signs you're seeing that it's accelerating?
So white swan is different from a black swan. Black swan is something that comes out of nowhere. This is not this is not controversial. The housing market's been slowly grinding to a halt, and then we expect pricing to come down. There's a lot of people who agree with us. This is not something that is undiscoverable. It's coming out of nowhere. It's just a cycle. And, you have a real estate industry that never wants to admit that anything's going south because they want to sell. But real estate, new permits peaked in 2022. And usually that leads prices. But the reason why we stayed so high for so long was illegal immigration kept a bid under the market through rentals and multifamily housing projects, which are longer lived construction projects than single family homes. Single family homes usually from permit to finish is 1 year. Multifamily structures are longer. So that's kind of kept the market afloat, but that's all rolling over. New permits continue to plunge. The metric of homes for sale versus homes sold has never been wider. Usually that time series, we have a nice chart in one of our real estate reports and I think in our U.S. Economic Outlook report that shows that time series usually follows each other. Homes for sale and sold they kind of go, but this time we have this gap like this. It's unprecedented. So the market's frozen. Pending home sales are at the lowest they've been in forever. So the market's frozen, and so what we have is an unrealistic seller community and people who can't afford to buy homes. In our report, we talk about home affordability. It's about 30% overpriced, and we think home prices need to correct 30%. It'll overshoot to the downside, and it's gonna, it can either happen fast or slow. But I think it's going to pick up and accelerate as the rest of the U.S. economy slows and there's more layoffs, and we're seeing that. New tenant rents really started to unwind and go lower in the fourth quarter of 2024 when Trump was elected. And so new tenant rents lead all tenant rents, which lead home prices and inflation. And inflation, 36% of the CPI is shelter, and that's a big component of the CPI, and that's all rolling. There's a firm called Trueflation. I'm sure you're aware of them. They're showing that inflation's running a lot lower than what people think it is, and the bond market is starting to figure this out as well. The 10-year broke below 4% today. The 30-year bond is rallying in price, going lower in yield. And the long end of the U.S. government treasury market is priced by two things and two things only: growth expectations and inflation expectations, not the deficit. So there's been this thesis that, to fund the deficit, yields on the long end are going to explode. Well, not true if growth is slowing and inflation is rolling over. And we're going to see, I think, a big risk-off market this year, and our call is that long-duration treasuries are going to be the best-performing asset class for 2026. For retail investors, I don't recommend, exposing yourself to interest rate risk if you're worried about your portfolio. Maybe just raise more cash, to have dry powder to buy opportunities later. If you're institutional, you can look at the long end and make your bets appropriately. But that's our call. This is coming after one of the worst bond bear markets we've seen in the last 40 years. Bond returns were abysmal after the Fed went on its unprecedented interest rate hike in 2022 and 21. And if you look at the long-term charts, yields have been stubbornly sticky in the U.S., meaning, the long bond doesn't really want to go above 5%. And the Fed has been lowering the short end of the curve a little bit, but they're still way too tight. Real interest rates are still running around 1%, which the neutral would be 100 basis points lower. And I think what you're going to see is, and let's also talk about the inverted yield curve. We had the longest inverted yield curve ever, I think, in the history of the markets. And then it started to uninvert. And the normalization of the yield curve is usually the recession signal, and that's been normalizing pretty fast going into 2026. It tried to do it in the beginning of 2025, and then it kind of flattened out a little bit. What really kind of held up the economy was, the mass deportations didn't really come in. They did shut down the border. That may pick up, but that's a second derivative change, and that's been enough to start the slowing growth in the U.S. And also we had the AI infrastructure build. So that kind of propped up GDP for a little bit. But this last quarter GDP came in quite weak. The expectations were, the people were, the Trump administration was talking 4.5%, came in at 1.4, and it showed a lot of alarming deceleration. So I think when we go back, we've been in an employment recession for a while. The non-farm payroll numbers, I've spoken about this last year, they're garbage. And non-farm payroll is a monthly estimate, and then the real data comes in usually 9 months in arrears, and it's found in the quarterly census earnings and wages report, which is when everybody has to report all the data. And the non-farm payroll numbers were off 4 standard deviations in 2024 and 8 standard deviations in 2025, which mathematically says to me, whatever the non-farm payroll number is that prints, it's garbage until the error rate comes down. So, the market finally started to realize that the non-farm payroll number might be garbage when everything was revised for 2025. And that's really when the long end of the curve started to pick up.
Now, the broad market at the moment, propped up by a handful of tech and AI names, is still grinding slowly higher. I don't know many guests on this show who don't agree that it's in a bubble at present, and you've spoken about that on this show a few times before as well. You mentioned current valuations imply a forward 10-year return of 0%, so I'd like to unpack that. Which metrics are leading you to that conclusion? And what would you need to see to officially declare that the bubble has begun to burst?
It's just a valuation tool. You look at the dividend yield of the S&P versus corporate credit, and it's at a historically low range. And when it gets to this range, historically, the projected 10-year return is 0, which implies a big drawdown in the market. Now, people might argue this time's different, but capital is capital, and capital eventually will figure this out. There's a free report on our resource page on our website, financetechnologies.com, with a PH under the tab resources, and we put out a report at the beginning of last year saying the same thing, and it only got more expensive. So it's even worse. The valuations are even worse a year after we put out that report, and it goes through all the math. You can read it. It's free. So go there if you want to get the explanation of, and we're not the only ones saying this. This is not controversial. This is classic math 101, mean reversion. Now, again, the argument is it's different this time, and AI changes everything, but I'm not a big believer in that. So the valuations are crazy. The Buffett indicator, other indicators are all, .com level metrics. And, I've been here before, and nothing's ever different under the sun. I want to point out, I know it's easy to say that the market's been grinding higher, but if you look at the chart, it hasn't gone anywhere since October. If you pull up the long-term chart of the S&P, it's been putting in what we call a slightly rounded top. My best bet short term, and again, I'm not trying to give trading advice. I think there's a false breakout higher to a new all-time high, and then everything collapses after that. So we're in this, what we call on Wall Street the distribution phase. Markets going sideways. The insiders are getting out. If you look at insider selling, I don't think there's anybody buying any stocks. People are alarmed by the insider selling, record insider selling. So, they sell their shares, retail buys it. Retail usually comes in at the top. And I think a couple of weeks ago, we saw like the largest retail purchasing of the stock market on record, 48 billion. So the signs are there. The signs are there. And the AI bubble is starting to crack, in my humble opinion. I have a unique background in finance. My career started in fixed income. I was an institutional bond salesman, so I got to understand the credit markets quite well. Then I went back to business school. Then I went to equities. So I have a lot of respect for the bond market and how it interoperates with the equity markets. And credit guys are usually ahead of the curve when it comes to the equity folks. Equity folks are into momentum and narratives and stories. Bond guys want their money back. And if you look at what's going on in the AI infrastructure, and CoreWeave reported last night, that stock I think is down a little bit here today, and the numbers weren't great. The CDS, the credit default swaps on CoreWeave and Oracle, have been going and grinding higher, and there's a private credit problem starting to unfold. We got Goldman Sachs and Morgan Stanley down 7% today, based solely on the fact that the private credit markets are starting to freeze. That's evident from Blue Owl gating their clients. So this is how it begins in every cycle, and at the end of every cycle, there's what we call the Ponzi finance part of the cycle. And I'm not saying it's like a Ponzi scheme. It's what they call it, the Ponzi finance, and it manifests in different cycles. So in 00, it was companies without any cash flows, getting loans on spec that they'd have future internet revenues down the line. Like the CLEX, these were speculative telecom companies funded by junk bonds, and they had zero cash flow and not a lot of revenues. And so the ability to pay back the debt was based on their momentum and their stock valuation. Once that cycle breaks, it goes the other way. And we kind of see the same thing. And then we had the subprime Ponzi part of the great financial crisis, giving money to people that couldn't afford to ever pay it back. And now we have the Ponzi finance AI bubble and private credit, which has been funding businesses that are zombie companies, and the hope is that valuations go higher to refinance the debt. That's all unwinding, and so that starts the credit Jenga tower to go from growth to plateau to starts to have credit contraction, and that has knock-on effects. It starts feedback loops everywhere. So credit's probably tightening as we speak. And this time it's a little more concerning. We have an AI bubble, so a stock market bubble, and a housing problem. The good news is the housing problem is not as bad as it was in 2008. The consumer is not as leveraged as they were back then. I think the banks will be able to manage it, but there's going to be a deep recession. I don't think it goes systemic. There's going to be big scares. So we're not calling for a systemic issue where we're going to need, massive bank bailouts, but there's going to be a lot of pain. And, we didn't have a systemic issue in the .com bubble, and the stock market went down 50%. So, we're projecting a 40 to 50% drawdown at some point in the stock market. And, it's not the end of the world. And the people that I've been talking to, that I consult with, I just recommend to them, have dry powder in your portfolio to take advantage of the opportunities. It'll mitigate you on the downside, and then when you reinvest, and the key is reinvesting. And timing isn't perfect, but if stocks are down 50%, I'd start deploying, the cash you built up again, and that's what Warren Buffett's going to do. Warren Buffett, like us, we were early on this because we were wrong about the illegal immigration really kind of distorting the economy. So we were off on our recession call. Warren Buffett was as well. He's been accumulating cash for 2 years, and he's ready. So the key is the storm's coming. Step to the sidelines a little bit. Don't panic, and then go back in.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. That's a really interesting analysis because that leads into my next question, which was how long do you think this drawdown could last for? Because I've spoken to some people such as Dave Collum, who thinks we could be in for a decade plus of the market grinding sideways after a massive correction before we see the previous highs again. And of course, the strategy of so many has been to simply dollar cost average into an index fund. People almost treat it like a glorified savings account. Just keep putting money into the S&P index. Is that still a viable strategy in the long term? Do you think ultimately the broad market recovers out of this in a reasonable time frame?
Well, if you have a drawdown of 50%, there's going to be bargains everywhere, and if you're especially a retired individual and there's like a blue chip stock that has a fat dividend yield because of a dislocation, you buy it because you're going to get income from it, and don't get too concerned about the market. Now, I do think after this dislocation unwinds, it's going to take a very long time to go back to new all-time highs. But if you buy right and you're getting income off the stocks, you shouldn't worry too much about the sideways move for the next 10 years. Now, if you buy, in a sideways move at the top right before it goes down again, which is what a lot of people do. A lot of people will sell at the bottom of this cycle, not get back in because they're anchored to the fact that they just sold, and then the market will go up for a year or two, and they'll probably buy at the top of that, and then it'll go down again. It'll be like the Japanese stock market, sideways for a while, but it's going to be great for fundamental investors and traders. Bull markets make everyone a genius, and that's why indexing and passive investing has taken over. There was a passive investing trend that was going on during the Nifty 50 in the 70s. And so if we go into a market that is more sideways, that can actually make people who are fundamental investors attract more assets, the ETF companies of the world will start to lose share because in a bull market, passive is the way to go. And there's going to be a lot of problems if we're going to a 10-year sideways decade market. A lot of trends that have been going on are going to unwind, and the Larry Finks and the Vanguards and the State Streets of the world are going to probably lose flow over time.
There's been a lot of mixed discussion on the state of the Chinese economy, from it's on the verge of collapse to they are destroying the US and will soon be the global superpower. What makes you think we're entering the acute phase of a crisis in the country, and what will the implications of the contagion effects of this crisis be?
So it's important to understand China is a net creditor nation. That means they have a lot of reserves. So they can fund this crisis internally, and they're not going to be subject to the whims of the foreign investors. Like in Thailand, there was the Asian contagion crisis, where a lot of capital went into Thailand. Then there was a problem, and then capital was pulled out. China can manage this, but it's going to have global contagion effects because what's been going on is they hit a demographic plateau in 2015, and then it went sideways. Then it started to roll over in 2020, and it's accelerating into 2032. And they're not going to lose 150 million of prime age working people, which changes the whole dynamic of how you spend. And so their economy, we put out some great reports, an institutional class report, and then a cheaper price retail version. And we show basically that China's GDP, priced in dollars, was 80% of the U.S. GDP in 2019. Since 2020, it's gone to price in U.S. dollars, its GDP is 60%. They've had, since the real estate bubble burst in 2020, it's been a slow grind lower. And so to compensate for that, they started massive exporting. So they tried to export their way out of this problem. And that has worked to some degree. But we now have trade wars. So that's a problem. The second problem is housing permits are down 70% from the peak. What's more alarming is that a lot of these projects were long-lived projects. And so construction is only down 20%. New construction contracts peaked last year, and they're accelerating lower into this year. So that's why we think we're going into the key phase. Their internal economy is having deep problems. And if you look at their latest GDP number, it was 4.5% in the fourth quarter. That was the slowest GDP growth for them in the last 3 years. Then there's other metrics like net fixed investment. That number is now year over year below zero. The year over year growth rate on a monthly basis is below zero. It's never been below zero except briefly during COVID, if you look back at the last 30 years. So they've never seen this. Then additionally, we looked at electricity consumption. That growth is about to cross over into zero. So there's something definitely going on in China. And is China going to collapse? No, China, it's not going to collapse, but it's going to be very bad there. And that's going to have and their internal consumption is going to drop. That's going to affect their trading partners like Japan, South Korea, others in the area. So it's going to be this contagion effect, and there's going to be, a lot of problems. It's just going to add, you have the housing crisis in the U.S., the stock bubble, then you have China. All three of those are all bearing down this year and make for a cocktail of, slowing global economic growth. And again, I think the bond markets the U.S. bond market is starting to sniff this out. And the Fed is woefully too tight, and they're going to be chasing this down once it gets going. We're 1% too high. Neutral would be 100 basis points lower. And of course, they'll overshoot neutral. They'll go below neutral.
And would you be staying away from Chinese equities at present? Because there's a lot of people pointing out that they seem to be very undervalued here, or are they cheap for a reason in your view?
They're cheap for a reason. And I think I haven't looked at Chinese equity stock charts, but I think they've had a rally recently, and that, they were already in the tank a couple of years ago. I think they've had a nice rally. And I think it's just like, probably, like what happened in Japan. They're Japan 2.0. It'll peak, the rally will peak out, and then it'll go, it's in the sideways market. And I wouldn't be buying Chinese equities here. They're Japan 2.0. So Japan ran into a similar demographic headwind in the 90s. And, there's a lot of calls and a lot of, people always are anchored in the past. And there's a lot of people out there that say China's won, China's taken over the world. Well, the numbers suggest otherwise. China's in trouble, and they have a demographic problem. Just like I remember in the mid-90s, Japan was entering a demographic problem, and everyone said Japan was going to take over the world. I was in business school in 1995, and we had, a project we had a project where we had to do team building exercises and make presentations, and the topic was, is Japan going to overtake the U.S.? And we were the only team that said no. We got an A because we had a lot of good evidence, but the professor didn't agree with us. And it was because everyone was looking at, the data in the rears, and we were the only ones that looked at demographics, and we said demographics are destiny. And that ended up being true. After, around 95, they really peaked in 89, but it became apparent to everyone that it entered the lost decades of deflation. And China's going through the same thing. Just to give you some numbers, so they, in 2020, they had 900 million in peak age working workforce. By 2032, that's going to drop 150 million. So that's a half a U.S. And they're aging, and their birth rates aren't, and they don't have enough people to support the elderly. They don't have a safety net in China. So it's even worse because they don't have a consumer spending engine. So a lot of people, once they leave their job, they've saved up their money. They go into like conservation mode, and they're not going to retirement homes. It's a whole different dynamic. There's no safety net in China.
Since the last time we spoke, we've seen an incredible run in the precious metals, especially silver, with it closing at an all-time high of around $117 near the end of January before collapsing 26% in a single trading day, now steadily creeping back to triple digits. We're at around $93 the last time I checked today. What do you think has driven this price action in silver, and do you expect it to reach new all-time highs this year?
Good question. So silver finally played catch up with gold. I mean, people had been screaming for a year about the silver gold ratio, and it finally happened. Um, and I think long term, gold and silver are going to grind higher. Primarily because everybody under the sun thinks a new monetary system's coming at some point. And watch what they do, not what they say. And every central bank is accumulating gold. Every commercial bank in the U.S. is now accumulating physical gold because they made it tier one capital. China's accumulating gold because they have to depreciate their currency to keep selling into the global markets. India keeps buying gold. So gold, gold, gold. So there's a variation, and also we all know there's a global sovereign debt problem, and people as we roll through time and the deficits get bigger and the demographics get worse, more and more people want an asset that's not someone else's liability, which is gold. So gold is, I think, got long-term fundamentals that are great. That's strategic. Tactical, it's a little more problematic. So, if you look at the charts of gold and silver, they've had tremendous moves going up into this part of the cycle, much like gold did going into the great financial crisis. I don't want to predict what gold's going to do, but if there is a general risk off trade, gold and silver may participate in that, because as people unwind leveraged bets and have to sell what they can, not what they want to, it might take a hit like it did in the financial crisis. But I want people to understand, in the great financial crisis, gold went down quite a bit in the Lehman event. And again, we're not calling one. It did recover and go to new all-time highs more quickly than the U.S. stock market. So I suspect if there is a pullback in gold or silver, it's a good buying opportunity. My best guess is that we consolidate sideways for a little bit, and then that's what I'd like to see. That would be a healthy thing technically, to see some consolidation and then another run up. If we see a parabolic move in gold and silver soon, that would really scare me. That means something's really gone off the wheels behind the scenes in the global banking system. And then, usually a parabolic blow off top means you don't want to be chasing it if it happens. But long term, I love gold and silver, and I'd love to see it consolidate, for a year or so. And if there's any kind of major sell off, I would accumulate some on dips, physical, that is, not the ETF.
And how do you view silver versus gold? Obviously, silver having much more of an industrial component. Do you see it as a more speculative asset in the long run? Because obviously, there's all sorts of narratives out there about shortages in the silver market. According to the Silver Institute, we're in our 6th year of a supply deficit in the silver market. Industrial demand, obviously, very strong. People point to solar panels as one of the main drivers. I don't really see that, because I don't think solar is going to, dominate the world like people thinks it is. But nonetheless, it's used in so much industry. So how do you see it as more speculative, whereas gold is more of a monetary asset, silver is more of a industrial? How do you see that?
Yeah, if you look historically at the math, silver is more volatile than gold, and it does have a correlation to economic cycles. So if our colony economy is right and industrial demand drops, silver will get hit harder than gold, and that's just the way it is. It's always been that way. I'm a gold guy because it's going to be part of the new, and silver may be part of the new monetary system, but I definitely know gold is, and so gold is more volatile. I mean, silver is more volatile. It's got higher beta, and that's just the way it is. So if you can stomach the volatility, you can make tremendous amounts of alpha. If you can, weather the storm and you're not leveraged. And if you're just a physical buyer and you're just stacking it because you're young and you want to retire and it's part of your total portfolio, again, don't ever put all your eggs in one basket. And I've been recommending to people 5 to 10% of your total net worth in physical, precious metals. But if you're a long-term holder, you don't want to get scared out of this stuff. It's not worth trading it, in my humble opinion. I mean, if you're a trader, you can use the ETFs if you're a day trader. But again, and don't use futures. Futures, I mean, there were a lot of specs in gold and silver that got blown out when the CME, because they can play games. They can increase the margin requirements, and then you're blown out. And that's how they manipulated silver lower. It was blowing up the silver futures longs. But long-term silver prices are going higher.
And do you have any thoughts on the gold and silver mining equities and just the commodities complex in general? I know you're bearish on oil moving forward. We've discussed that before, but are there any other commodities outside of gold and silver that you think will perform well after this kind of broad market bubble bursts?
Well, we have to see. So basically, our economic commodities won't do well temporarily. So we're bearish on that. There are some commodities that are doing better than others, like copper. That's because China is hoarding. China has so much money supply, they're just acquiring real assets because they're going to depreciate their currency. So there's some hoarding going on. But when you really need to see, globally we have a demographic problem. So that suggests less demand for commodities in general. However, if the authorities in this next downturn respond with unprecedented monetary printing, we could have a commodity cycle. So, our call on commodities is like to be determined once we see what the response is once this unfolds.
Gold and silver miners, and any thoughts on that sector?
Oh yeah. So the gold and silver miners, they're at the end of the day, they're equities. So if the equity markets are going to have a general drawdown, they will participate. They may outperform on a relative basis, so you might lose less money. And if you look at the charts of a lot of these stocks, they've been fantastic already. Which, I don't like to buy charts that look like this. I like pullbacks, but you may get your pullback in an equity drawdown, and then longer term, the fundamentals are good. And I think the silver and gold miners will probably do well on the other side of any kind of equity drawdown.
Well, let's get into government corruption. I want to discuss the Epstein Files here for a moment and ask the question, what surprised you the most about the files so far? What suspicions have they confirmed? And what impact do you think they will have on the future of politics worldwide?
I was very suspicious in 2020 and 2021 of what was going on globally with the COVID pandemic, vaccine coordination and messaging. And lo and behold, we find out in the Epstein Files that Bill Gates and Epstein and others were talking exactly about this, how to profit off of a pandemic. And so, that angle needs to be really super investigated. Bill Gates needs to be deposed by someone. I always suspected there was something. I mean, to me, intuitively, I thought that, but I couldn't say it publicly. I could hint around it, but now we have some real hard evidence that this was a plan. It boggles the mind that these supranational hidden operations could coordinate this. And what we're learning from the Epstein Files is that it's an operating system. So we have the public-facing, institutions. But we find out there's a layer of people above them that know how to manipulate that whole thing to their benefit through compromise and blackmail and money laundering. Let's not forget Epstein was involved in money laundering. That's how a lot of the stuff was. It's all dark money. And the other thing that surprised me this angle I didn't think of, and again, we'll find out more, but Bitcoin has been tied to Jeffrey Epstein, and he's been involved in, taking over the network and funding it. I don't know what to think of that. Intuitively makes sense. If you wanted to, set up your own dark money blackmail operation and launder money, Bitcoin would be the perfect way to do it, I guess. So, there's a lot that's being revealed, and I don't know what that means for Bitcoin long term, but it certainly kind of disrupts the narrative that Bitcoin is freedom. I mean, that was kind of one of the narratives that we were hearing. And I've never been a Bitcoin bear or bull. I've always said it's a proxy for Nasdaq and liquidity trade. Buyer beware. It's not a store of wealth. It's very volatile. So that's what it's always been to me, is a volatile, 95% correlated asset to the Nasdaq.
It seems the Trump administration is doing whatever they can to distract from the Epstein files and bury the truth, including the fact that Secretary of Commerce Howard Lutnick has repeatedly lied about his relationship with Epstein and yet remains in his position somehow. You wrote on X, Howard caught lying about relationship to Epstein from Epstein files and his firm profiting from adverse tariffs ruling. If this guy remains, it's telling and not in a good way. So why do you think this administration wants to bury the files and keep such absolutely corrupt individuals as Lutnick on board, who, as you mentioned, has also set up his family to profit from the Supreme Court's tariff ruling?
Yeah, let's talk about the profiting. There were some news stories that came out about that. So when I wrote that post, that's what I was referring to. Then they came out. They came out and adamantly. Cantor Fitzgerald came out and adamantly denied that. Okay, that's fine. But I read the press release, and they used the word execute, and that if you're an agent and you're facilitating, and acting as a broker or an agent, that doesn't necessarily mean you execute the trade. You just get a commission. So, they denied it, but the legalese with which they used the term, did not execute or take any proprietary positions. That may all be true. They didn't legally execute a trade. They didn't take a position, but they may have profited from, setting up these trades. We don't know, but that needs to be cleared up. So, but what we do have Howard on dead to rights is his absolute utter lie about his relationship with Epstein. I mean, he got on, I think it was 60 Minutes, I believe, said X, Y, Z. Then the Epstein files reveal a whole plethora of, business relationships. He supposedly bought his mansion next door to Epstein for $10. His sister's involved. He actually went to Epstein Island. So he's caught dead to rights lying on that. So the firm profiting is less clear, needs to still be investigated, but he's caught dead to rights. And, I don't know about you, but, I'm tired of people getting away with nonsense and lying their asses off. And, the Trump administration just needs to be better. And, the other problem I have is, the Epstein files were, not, they indict a lot of Democrats as well. So the Democrats look awful here, but, it was obviously not good news for Howard Lutnick and some other high profile Republicans. Let's not forget, Howard Lutnick was a Democrat, and he kind of switched sides. Then, of course, we dropped the alien nonsense. All of a sudden, we're going to have alien disclosure. They're interdimensional beings and yada, yada, yada. I'm sorry. That's just too much.
Yeah, that's interesting because, well, first of all, one comment I want to make about Lutnick, when he then admitted to, yes, I did go to Epstein Island, for some reason he made a point of saying, with all of my children, like that somehow changes things. I don't know what that was, whether he was trying to say it was innocent because I was with my children. It's still a total lie. Now, I want to follow up on the biggest distraction of all, which is the aliens angle. As you mentioned, you also noted on X that unless the aliens are going to lower the cost of living and give people jobs, this tactic is not going to work. Is this desperation? Are the aliens real? And what, if anything, would releasing classified documents on extraterrestrial life accomplish at this point? I think people want to see the predators in the Epstein files prosecuted more than anything. I don't see any distraction that's going to work at this point. But hey, the news cycle moves quickly. People are easily distracted. Maybe I'm wrong. What's your take?
Yeah, I personally believe one of the biggest frustrations, and the polling numbers reflect this, one of the biggest frustrations with the Trump administration, I'm not talking about myself or you, but I'm talking polling, is accountability and immigration. And he kind of pulled a 180 on immigration recently. He's, deportations of only criminals, which, is a de minimis amount of people. So he's walked back his promise there. And the accountability, there's no one that's been held to account from COVID, from Russiagate, from lawfare gate. I mean, no one has been held to account for any of the crimes that we've seen. And now we have and then throw the Epstein Files on top of that. No accountability. I think people are being slowly blackpilled and giving up hope, which I don't think people should do, but that's what's going on. And the Trump administration now knows they're in trouble because the polls are disastrous. They're going to lose the midterms unless they do something. And the aliens angle isn't going to save them. Let's just say that. I mean, again, first of all, when Donald Trump says he's going to disclose the alien files, if you dig a little deeper, there's a whole bureaucracy built around secrecy. They won't let him do much of anything. So we're not going to, whatever it does come out, it's not going to be much. So it seems to me this was a big distraction, gets a lot of the UFO people excited and whatnot. The thing to watch for is, look, I've talked about the money, the debt-based fiat system, and it needs bigger and bigger credit growth and, excuses to up the size of the credit growth. And COVID was a perfect excuse that saved the global economy in 2019. It was clearly rolling over. We were having plumbing issues. And then voila, COVID came and we had basically unprecedented money printing and deficit spending. It was warlike spending. And that kicked the can down the road. And here we are again, and it's probably going to unwind. And the only thing that really saves the credit creation, if you're trying to prevent the cycle from completing, and that's what bankers want to do. They don't ever want to take losses. You need a war, or you need I jokingly said a couple years ago, fake alien invasion to justify the amount of spending to keep this thing going. And sure enough, the aliens are showing up again. I don't know if that's the reason why, but they're definitely being used as a distraction, a definite distraction.
Well, Edward, tell us about finance technologies and anywhere you'd like to direct people online who want to follow your work.
Yeah, so financetechnologies.com with a PH instead of an F. We have all our U.S. economic reports, China report. We have some real estate reports. You can buy packages or one-offs, whatever you want. We also have email that you can sign up to subscribe to Finance Technologies website. I also have a personal website, eddowd.com, and I'm found on X at DowdEdward. And I post frequently. And, there's just a lot going on. And I think I'm more confident this year that we're going to see something start to unwind.
Great. Well, I'm going to put links to everything you mentioned in the description below for people who want to check that out. As always, great having you on, Edward. Thank you so much.
Thanks, Jesse. Great to be here.
Thank you for joining us today. Our sponsor, ARC Silver Gold. Osmium has some great specials on gold and silver bullion products. They are on your screen right now. These are well supplies last and subject to change. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and represent sound money in style with the exclusive Stack Silver, Not Fiat t-shirt available at the Commodity Culture shop using the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.